So how exactly does an all-time record, $23.1 trillion in U.S. money supply, collide head-on with a surprisingly hawkish Federal Reserve?
Right, and not to mention a totally pivotal jobs report dropping at the same time.
Exactly. Welcome to today's Deep Dive, everyone. We have a fascinating stack of daily trading desk notes in front of us. Our mission today is to map out the exact numerical levels, the leverage dynamics, and the shifting narratives driving the market right before this July 4th holiday weekend.
Yeah, we're going straight into the raw data today. Just a heads up for you listening, we're looking at this purely through an impartial lens.
Right, entirely devoid of financial advice or buy-sell recommendations. We're just decoding the exact desk data and the stories behind those numbers.
And, well, the terrain right now is essentially a map of extreme contradictions. The macro forces are just pulling in completely opposite directions.
Yeah, especially when you look at the raw mechanics of the U.S. money supply. I mean, we just hit that record, $23.1 trillion.
It's a massive number. But to really understand the market impact, you have to look at the velocity of that injection. In May alone, the system saw a $247.8 billion expansion.
Oh, wow. Almost $250 billion in 1 month.
Exactly. It's the single biggest one-month jump we've seen in 5 years. Year to date, that equates to a $698.6 billion expansion of the economy's liquid layer.
Which normally, that acts like absolute jet fuel for asset prices.
Right. It guarantees easy financial conditions. But, and here's the paradox, the desk notes point out the market is actually pricing in 2 interest rate hikes by March.
Wait, 2 hikes? With that much liquidity flooding the system?
Yeah. The catalyst for this recalibration came from Fed Chair Kevin Warsh. At a recent central bank forum in Portugal, he made it abundantly clear that prices are still way too high.
So the guy controlling the cost of capital is signaling tightening, while the money supply is just screaming expansion. It's like watching a driver slam the gas pedal to the floor. That's your $23.1 trillion in liquidity, while simultaneously ripping back the emergency brake with those rate hikes.
That's a great analogy. And I mean, you can only run an engine under that kind of extreme mechanical stress for so long before something snaps.
Right. The friction builds up.
Yeah.
And that makes the market incredibly sensitive to the next data point, which brings us to tomorrow's jobs report.
Yeah, tomorrow is the catalyst. The report drops exactly 1 hour before the market opens. Consensus estimate is hovering right around 110,000 jobs added.
And to gauge how the market will react, we really have to look back at last month. On June 5th, the economy added 172,000 jobs against an expectation of just 80,000.
Massive beat. And normally universally celebrated, right? People are working.
Yeah, but in this specific regime, good news for the labor market is instantly interpreted as terrible news for asset prices.
Exactly. A strong economy means the Fed has zero incentive to lower rates. That June 5th report totally killed any near-term rate cut hopes.
Right, the S&P's main tracking fund dropped 2.58% that day. It sparked a 4-day bleed.
The market is just hostage to the rate narrative right now. And the underlying structure of the market is incredibly delicate heading into tomorrow, mostly because of the leverage involved.
Let's unpack that leverage data, because this is where the desk notes get genuinely alarming. We're looking at Fann and Rye margin debt data.
Right, the borrowed money investors use to finance stock positions.
Yeah, and when you measure that margin debt against the size of the record money supply, we are at the second highest reading in history.
That's wild. Only eclipsed by, what, the dot-com bubble?
Exactly, the dot-com bubble. And the last time we saw levels even approaching this was in the 2007 to 2008 window.
Wow. Margin debt is really the silent multiplier of volatility. When you have historic leverage across the whole system, a sudden drop in price triggers forced automated selling across thousands of portfolios all at once.
Nobody calls a market top on one single metric, sure, but doesn't this historic leverage mean the market is essentially a room full of gunpowder waiting for tomorrow's jobs number?
I mean, mathematically, yes. It guarantees the velocity of the move. Small reactions are almost impossible when the system is this levered.
Which is exactly why mapping the exact technical levels is so critical right now.
Totally. Looking at the SPY index fund, it is pinned under a massive resistance wall at exactly 750. Options dealers are heavily incentivized to defend that level.
Right. It creates a self-fulfilling ceiling. It popped over yesterday's high, tried to run, and just got brutally rejected at 750 again.
Yeah. Now, if buyers chew through that, you get a short squeeze, but looking at the trapdoors below 750, it's pretty vulnerable.
The desk notes highlight a specific shelf between 742 and 743. That's the first line of defense.
And if 742 breaks,
the selling pressure accelerates down to 740, and then the truly critical zone sits between 732 and 730.
Plus, we have to overlay the seasonal calendar on those numbers. Historically, July is the friendliest month of the year for equities, 10-year green streak since 2014.
Right.
But we are in a midterm election year. And the data shows that in midterm years, the July through October stretch is exactly when volatility spikes massively.
It's such a binary setup. The friendliest month and the midterm storm season begin on the exact same day, all while we're suffocating under that 750 feeling.
Yeah, the tension is palpable.
And just purely as a situational awareness calendar item, the state funeral for Iran's Ayatollah Khamenei is running July 4th through the 9th.
Right, overlapping directly with a closed U.S. market weekend.
Exactly. So professional desks are hyper-aware of gap risk. If news breaks over the weekend, investors can't react until Monday, which causes the market to gap violently open at a different price.
It's a textbook liquidity vacuum. And with all this macro tension, capital wants to rotate into less crowded trades.
We're actively seeing that rotation now, especially as the AI chip trade, the engine of this whole rally starts to crack.
Yeah, Meta closed up almost 9% on news they're spinning up a cloud business to sell excess AI computing power to outsiders.
Which is exactly the SpaceX playbook, right? Build massive infrastructure for yourself and then sell the spare room to competitors.
Exactly. It's brilliant for Meta, but for the AI infrastructure stocks, complete panic.
Yeah, because it signals a massive shift in supply and demand. If the biggest builder is renting out spare equipment, doesn't that mean we have enough equipment?
That's the fear. Applied Materials, Lam Research, SanDisk, they all took hits. But Micron, ticker MU, plummeted 10.5% today.
Ouch. 10.5% for a company that size is huge.
It's a structural repricing. It brings Micron right down to test its critical 1,000 to 1,025 floor. It bounced exactly at 1,024 on Monday.
Breaking below 1,000 bends its daily uptrend, right?
Yeah.
That $1,000 mark has immense psychological weight.
Totally, and they're fighting a second battle too. Apple is reportedly lobbying to use Chinese memory chips.
Which directly threatens the monopoly held by Micron, Samsung, and SK Hynix.
Right. Memory chips are essentially the lumber of the tech industry. They're commodities. Introduce a cheaper Chinese competitor, and those massive profit margins collapse overnight.
So if the easy money has been made in AI hardware, that hot money has to go somewhere. The desk notes show it rotating into beaten-down software and cloud security.
Makes sense. The hardware is in place. Now enterprises have to secure the data it generates.
Exactly. Look at Salesforce, ticker CRM. Trading around 364, which is barely half its December 2024 all-time high, but it just put it in a strong recovery session.
Spotify is doing the same. Ticker SPOT, trading near 472, successfully defending a 400 to 420 base after a grueling year-long downtrend.
Yeah, defending that floor proves institutional buyers are accumulating. Plus, they have earnings on August 4th with a 1 billion user roadmap.
But the most aggressive rotation signal has to be that massive whale trade in Rubrik, ticker RBRK.
Oh yeah, a $2.7 million options bet on September 2026 call spreads.
Right. They're buying the 90 strike and selling the 100 strike.
So they're capping their upside to lower the entry cost. If Rubrik lands in that $90 to $100 tunnel, that $2.7 million bet potentially pays out $6.55 million.
It's a highly calculated, defined risk strategy. And looking at the chart, Rubrik is testing a brutal ceiling at 86.50 right now.
Breaking that 86.50 level would actually invert a year-long downtrend. And the last time support held like this, it ran from 49 to 102.
Very compelling setup for institutional rotation.
Definitely. So to synthesize all of this, the desk notes lay out exact tripwires for these volatile momentum stocks.
Right, but remember the core philosophy of the desk: no break, no trade.
Exactly. These aren't predictions. Stop losses are non-negotiable. It's about extreme discipline.
So what are the specific momentum levels for tomorrow?
We've got three. First, Coinbase, ticker CoinN. The upside trigger is at 164.50.
Okay, 164.50 on CoinN.
Next, TDOC, ticker TDOC. Upside trigger is precisely 9.15.
Got it.
And finally, LUMN Technologies, ticker LUMN. This one is a downside trigger at 7.10. It's leaning heavily on the 7 handle. If it gives out and drops into the 6s, the path of least resistance is way lower.
If they don't interact with those exact numbers, you do absolutely nothing.
Right. So just doing a rapid recap here. We've got $23.1 trillion in liquidity fighting rate hike fears. We've got historic leverage waiting on a 110,000 jobs print.
The SPY is trapped under 750, and AI money is actively rotating into software.
Exactly. And I want to leave you with a lingering thought for this long weekend. We just watched a pristine, undisputed stock like Micron plummet 10.5% on just a hint of oversupply and new competition.
Yeah, that was brutal.
So if a titan like that can fracture so quickly, How incredibly fragile is the rest of this unquestionable AI narrative if tomorrow's jobs data throws a wrench into the broader economy?
That is the defining question right now. People assume these modes are permanent, but they can vanish in a day.
Something to mull over while you're watching the fireworks. Thank you for joining us on this deep dive. Stay disciplined, respect the levels, and we'll see you next time.